Bitcoin, the pioneering cryptocurrency, has experienced numerous price fluctuations since its inception in 2009. These price changes, driven by market forces, technological developments, regulatory actions, and macroeconomic factors, have made Bitcoin an attractive asset for traders and investors alike. In 2024, Bitcoin experienced a significant crash, which had impact on its price, market sentiment, and the broader cryptocurrency ecosystem. This crash, like previous downturns, can be attributed to a combination of various factors, including market speculation, macroeconomic conditions, technological issues, regulatory actions, and broader financial market trends. The 2024 Bitcoin crash was preceded by a period of remarkable growth in 2023, during which Bitcoin reached new all-time highs. At the start of 2024, Bitcoin's price had climbed to unprecedented levels, with many investors predicting further upward momentum. However, these optimistic predictions were soon tempered by a series of events that triggered the crash, leading to a sharp decline in the price of Bitcoin. One of the main factors that contributed to the 2024 Bitcoin crash was the increasing interest and scrutiny from regulatory bodies around the world. In early 2024, several governments and regulatory agencies, particularly in the United States and Europe, began to enter into entries. These regulations aim to address concerns related to money laundering, fraud, and consumer protection. While some of these regulations were seen as necessary for the maturation of the cryptocurrency industry, they also introduced uncertainty and fear into the market. Investors concerned about the potential impact of these regulations on the future of Bitcoin and other cryptocurrencies began to sell off their holdings, leading to a sharp decline in price. In addition to regulatory concerns, macroeconomic conditions played a significant role in the Bitcoin crash of 2024. The global economic environment in early 24 was marked by rising inflation, higher interest rates, and a tightening of liquidity by central banks around the world. These factors created a less favorable environment for risk assets, including Bitcoin. Investors who had previously viewed Bitcoin as a hedge against inflation and alternative to traditional financial assets began to reconsider their positions as the global economy showed signs of instability. As a result, many moved away from riskier assets like Bitcoin and sought safer investments such as government bonds and gold, further exacerbating the sell-off. Another important factor contributing to the Bitcoin crash was the increasing realization among investors that the cryptocurrency market, and Bitcoin in particular, was highly speculative. Many new investors had entered the market during the 2023 bull run, driven by the fear of missing out, FOMO, and the belief that Bitcoin would continue to rise in value indefinitely. However, as the price began to fall, these investors quickly exited the market, leading to further downward pressure on the price. This mass exodus of retail investors highlighted the fragile nature of the cryptocurrency market, where prices are often driven by speculation rather than fundamental value. The role of institutional investors in the 2024 Bitcoin crash is also worth noting. Over the past few years, institutional players, including hedge funds, pension funds, and publicly traded companies, have come and growth in the cryptocurrency market. While their participation brought legitimacy and capital inflows to the space, it also meant that Bitcoin's price became more sensitive to the actions of these large players. When some of these institutional investors began to liquidate their Bitcoin holdings in response to the regulatory environment and the broader economic conditions, it created a domino effect that triggered the crash. The sale of large quantities of Bitcoin by institutional investors led to a sharp drop in price as the market struggled to absorb the sudden influx of sell orders. Technology-related issues also played a role in the 2024 Bitcoin crash. While Bitcoin's underlying blockchain technology remained secure, there were growing concerns about the scalability and energy consumption of the network. As Bitcoin's price increased in 2023, the demand for transactions on the network also grew, leading to congestion and higher transaction fees. This created a negative feedback loop, as users became frustrated with the slow transaction times and high fees, leading some to abandon Bitcoin in favor of other cryptocurrencies that offered faster and cheaper alternatives. Additionally, the environmental impact of Bitcoin mining, which requires significant amounts of energy, growing point of contention. Environmental activists and policymakers pushed for stricter regulations on Bitcoin mining, which contributed to the negative sentiment surrounding the cryptocurrency. The media played a significant role in amplifying the 2024 Bitcoin crash. As the price of Bitcoin began to decline, news outlets and social media platforms were quick to report on the crash, further fueling panic among investors. Negative headlines and sensationalists reporting about the potential collapse of Bitcoin created a sense of urgency, prompting more people to sell their holdings. The media's tendency to focus on the most dramatic aspects of the crash contributed to the creation of a feedback loop, where negative sentiment fueled further price declines. The 2024 crash also highlighted the increasing importance of market liquidity and the role of exchanges in maintaining stability. During periods of high volatility, cryptocurrency exchanges can experience technical issues, including delays in order processing, withdrawals, and market data. These issues can exacerbate price declines, as traders are unable to execute orders quickly or at favorable prices. In some cases, exchanges have been accused of manipulating the market or engaging in practices that contribute to price swings. During the 2024 Bitcoin crash, several major exchanges experienced disruptions, which further eroded confidence and contributed to the downward spiral. While the 2024 Bitcoin crash was a significant event in the history of the cryptocurrency market, it was not the first time that Bitcoin had experienced a sharp decline. Similar crashes occurred in the past, including the 2017 bear market and the 2020 COVID-19 market crash. In each of these cases, Bitcoin eventually recovered and even reached new all-time highs. This history of volatility has led many to view Bitcoin as a cyclical asset, with periods of rapid growth followed by corrections and crashes. Despite the severity of the 2024 crash, many Bitcoin advocates and long-term investors remained optimistic, believing that the market would eventually recover, and that the technology underlying Bitcoin would continue to evolve and improve. The crash of 2024 also raised important questions about the future of Bitcoin and the cryptocurrency market as a whole. One of the central debates is whether Bitcoin can ever become a true store of value or a viable alternative to traditional financial systems. While Bitcoin proponents argue that it offers a decentralized, censorship-resistant alternative to fiat currency, skeptics point to its volatility and speculative nature as significant obstacles to its widespread adoption. The crash of 2024 further highlighted these concerns, as many investors were forced to reassess their beliefs about Bitcoin's long-term viability. The impact of the 2024 crash extended beyond Bitcoin itself, affecting the broader cryptocurrency ecosystem. Many altcoins or alternative cryptocurrencies were also hit hard by the market downturn. Cryptocurrencies such as Ethereum, Binance Coin, and Cardano saw their prices drop in tandem with Bitcoin, as investor sentiment soured across the entire market. This correlation between Bitcoin and other cryptocurrencies is not surprising, as Bitcoin remains the dominant player in the market, with a significant influence on the prices of other assets. As a result, the crash in Bitcoin's price had a ripple effect that spread to other digital assets, further highlighting the interconnectedness of the cryptocurrency market. The crash also sparked debates about the role of decentralized finance, DeFi, in the broader cryptocurrency landscape. DeFi platforms, which offer financial services without intermediaries, have grown in popularity in recent years. However, the 2024 crash raised concerns about the stability and security of DeFi protocols, as many platforms were built up of volatile assets like Bitcoin and Ethereum. As prices fell, some DeFi platforms experienced liquidity issues, and users were unable to access their funds or execute trades. This raised questions about the long-term sustainability of decentralized financial systems, and whether they can weather significant market downturns without relying on traditional financial institutions. In the aftermath of the 2024 Bitcoin crash, there was an increasing focus on the need for regularity and institutional participation in the cryptocurrency space. Many analysts and experts argued that clearer regulations could help stabilize the market and reduce the impact of speculative bubbles. At the same time, there was a growing recognition that institutional investors would play a key role in the future of Bitcoin and other cryptocurrencies. While the crash had caused some short-term damage to investor confidence, many believed that the market would eventually recover, especially if regulatory frameworks were put in place to address the concerns of both retail and institutional investors. The 2024 Bitcoin crash was a reminder of the inherent risks and volatility associated with investing in cryptocurrencies. While Bitcoin's price fluctuations have always been a defining characteristic of the asset, the crash of 2024 brought these risks into sharp focus. For some, the crash was a wake-up, a speculative market, and the need for caution when investing in volatile assets. For others, it was a temporary setback in the ongoing development of the cryptocurrency space, one that would eventually be overcome as the technology matured and the market became more stable.